Now we are moving to our second plenary session, which looks at tax trends in Asia Pacific region. Craig Milner from our Australian office, and we have Gokul from Taxand India, and we have Verinder from Taxand Malaysia. Now let's welcome Verinder.
Thank you, Kevin, for the introduction, and welcome back everybody from your coffee break. This particular session follows on a bit from what we saw in Plenary 1 when talking about BEPS in a bigger context. This has got some link to that as well, but fundamentally our focus is going to be on the Asia tax trends. A brief introduction in terms of the common themes that we have been seeing over the last few years, and we think many of this obviously will continue to be there right up to 2020 and beyond. We all know that the global landscape is changing, very clear. We also know that governments in a number of countries in Asia as well as in other parts of the world need tax revenue and are aggressively pursuing collection of tax revenue. We do not think this will change. This will continue to be the scenario even right up to 2020 because of the need to fund development in a country and to meet government operational expenditure. OECD influence on tax policy has actually been growing in this part of the world compared to perhaps 10 years ago or 15 years ago. And we see no change in this, especially because of BEPS, the base erosion profit shifting, where international tax avoidance has become a very important topic in various places, including the OECD, and that's really the driver for how BEPS has come into the picture. We have a new breed of tax activism, in particular in the US and Europe, in terms of what's happened in Starbucks, Google, Amazon. Not really in this part of the world, but it's something that is coming, and that is something that governments have taken notice. In particular, Australia and New Zealand, being developed nations, have actually taken notice of this, have actually announced certain things that will affect multinationals. Australia, for example, is thinking about, has actually announced, Craig, confirm if I'm right, that they're going to disclose the amount of tax that multinationals pay, and that is going to be public disclosure of this. And that's part of the response, really, to BEPS as well.
That's good.
In ASEAN, you have an ASEAN economic community from 2015, which actually encourages free movement of goods, minimal customs duties or zero customs duties, and that's an opportunity to look out for. Perhaps I could ask Gokul, from your perspective in terms of India, comments?
Thanks, Verinder. If we look at what's happening in India, what's happening in China, two large economies here in Asia on the corporate tax rates, I think both the countries have really found their sweet spot as far as the headline rate is concerned. It's 25 in China, it's 30 in India. But those are the headline rates. The effective rates in both these jurisdictions has been at least 8 to 10 percentage points lower. And that's because of the effect of the tax holidays, the tax incentive that both these countries actively pursued as a part of the tax policy over the last decade and a half. So really, if you look at corporate tax rates, they have sort of at the headline rate stabilized, plateaued. We don't see till 2020 any change in the headline rates. What we do expect to see is that effective rate could inch up marginally because incentives are going to go down. Coming on to the customs and the free trade agreements, Verinder, you're right, the ASEAN has led the way in this part of the world. At this point of time, there are about 500 FTAs in play in Asia, out of which 232 are already in effect. What we do expect to see by 2020 is a play where a far more number of FTAs will actually try and create Asia into a supermarket, into a super singular market.
The Australian government and the New Zealand government are focused on collecting revenue to deal with structural problems that they see with the tax system, and that feeds into the BEPS, the BEPS analysis that we heard from in the previous session.
Many countries already have general anti-avoidance rules. Some have specific anti-avoidance rules. India being the more recent one, which has actually introduced its GAR. We know that what's happened in Europe in particular tells you that in the past, taxes were an expense that we need to manage. Now we are beginning to see that society is demanding that taxation or taxes that you pay or supposed to pay is part of your corporate social responsibility. And that's part of why governments also feel they have a right to recover, of course, whatever lost revenue they have incurred in the past. The other thing to be appreciative about is that the tax systems in this part of the world were designed a long time ago. And many of these countries never factored in the digital economy, never factored in the global economy. And so you find that a number of the countries are actually going through a little bit of tax changes. It's not drastic reforms, but it's very ad hoc. So changes are being made as and when governments react to things that are happening. There are obviously in a number of jurisdictions case law developments. For example, Indonesia, you had the Asian Agri case on tax evasion. In Singapore, you have the AQQ case on tax avoidance. And that continues to be developments in the litigation area. And this is a result of aggressive tax authorities who challenge your transactions and so on and so forth.
These are part of a campaign that the government has fed in terms of making comments about the need for structural changes in the tax system in Australia and New Zealand. And it's been taken up by the media. So there have been some investigative pieces in the financial press where a journalist has reviewed the corporate filings of groups like Apple in Australia to determine the amount of sales and compared that to the amount of tax that's been paid in Australia. And it feeds into Virendra's point about tax being seen as more part of the corporate social responsibility. It is becoming part of those campaigns in which paying your fair share of tax is an important part of how your consumers view you and your brand.
Almost all of Asia has got TP rules and guidelines, so that's a given. The United Nations came out with a manual on transfer pricing to assist developing countries recently, last year, and to build capacity so that the tax authorities are able to manage the transfer pricing audits that they carry out. For a global or regional or multinational enterprise, you need to look at tax risk management even more closely, and you need to develop your global resources so that you can manage the risk in terms of tax exposures more effectively. Looking at addressing tax risk and controversy at a strategic level, and that means board involvement where necessary, and you need to take a global perspective. And this also means you need to have relationships with your tax authorities in different countries. And you need to manage that relationships as well as for multinationals. Thank you very much to Gokul and Craig and to all of you for listening. And we hope there has been at least some particular points that you can take away. Thank you very much.